Welcome to the deep dive. Ever wondered what it really means when a company's stock is traded publicly?
Yeah, it's like getting a peek behind the curtain, isn't it?
Exactly. Think of it like this. You're getting a chance to understand the inner workings, the story, and, well, the future potential of a business.
Precisely. And when you buy a share, you're essentially buying a tiny piece of that story. So our job today, really, is to act as your guides.
Helping you figure out if that story is one worth, paying attention to.
Mm-hmm.
And we've picked a fascinating subject for our deep dive today,
Mm-hmm.
the healthcare giant, Johnson & Johnson J&J, as most people probably know them.
Right. And we've got some really insightful analysis here from Morningstar. It gets right under the hood of the company.
Tells us what makes it tick and how, the financial pros actually evaluate its worth.
And look, the world of finance, it can seem like a maze sometimes, right? All the jargon, the numbers. But don't worry, we're here to be your shortcut, basically. Pulling out the crucial insights so you get a clear picture without feeling totally lost.
Okay, so Johnson & Johnson, what's the core business we're actually looking at here?
Well, to start, J&J is often called the world's largest and most diverse healthcare firm. That scale, that variety, it's significant right off the bat.
Most diverse seems key. They're not just doing one thing, are they?
No, exactly. After a big change in 2023, they spun off their consumer products into a new company, Kenvue.
Ah, right. I remember that.
So after that, J&J now really focuses on two main areas. The biggest is pharmaceuticals. That's like roughly 2/3 of their income.
So prescription meds, basically. What kind of health areas are we talking about?
Oh, it's a huge range. Think major stuff like immunology, so the body's immune system, and oncology, fighting cancer.
Okay.
Then there's neurology for brain and nerve disorders, pulmonary for lung health, also cardiology, metabolic diseases like diabetes. It's really comprehensive.
That's a wide net. And the other piece of the business?
That's their medical devices division. Makes up about the other third of their revenue.
And that covers?
A whole load of things. Surgical tools for operating rooms, orthopedic implants, think hip and knee replacements, that sort of thing. Stuff that helps people move again.
Drugs and devices. Pretty fundamental healthcare stuff. Where does most of this business happen, geographically speaking?
The analysis points out that just over half, maybe a bit more, of J&J's total revenue comes from the United States.
So global, but with a really strong U.S. focus.
Definitely. The U.S. market is clearly dominant for them.
Okay, now this is where it gets really interesting for me. The Morningstar analysis keeps mentioning something called a moat. Not the kind with water and castles, I assume.
No, definitely not the medieval kind. In business, an economic moat is all about a company's long-term competitive advantages.
Right.
Those special things that make it really, really tough for rivals to come in and steal their business, it's what lets them stay profitable, over the long haul. Defends their profits.
So, like a secret sauce. Keeps customers locked in and competitors away.
That's a great way to think about it. And Morningstar believes J&J has a wide economic moat.
Wide, so a really strong one.
Exactly. Very strong, very durable. They're not just saying J&J has some advantages. They think these are substantial and really hard for others to overcome.
Okay, so what builds this wide moat for J&J? What are the ingredients?
Well, there are several key things. First, in pharmaceuticals, it's intellectual property.
Mainly patents.
Right, protecting their drugs.
Yeah, patents give them exclusive rights to make and sell their new medicines for a while. Stops generic companies jumping in immediately with cheaper versions.
Makes sense. You spend billions developing a drug, you need time to earn it back without knockoffs flooding the market right away.
Precisely. And then in the medical device part, the moat comes from, well, a mix of IP, but also something called switching costs.
Switching costs. Yeah, think about a surgeon. If they've spent years getting really good with one company's knee replacement system, there's a big learning curve to switch to another one.
Okay.
They might be hesitant to change, even if a competitor is a bit cheaper, because of the time involved, the potential risk during surgery while they learn. So that familiarity, the expertise, it creates a barrier.
So doctors kind of stick with what they know and trust. That's a powerful loyalty, almost built in.
Right.
What else? What else adds to this moat?
Well, their sheer diversity is another big part. Because they're in so many different healthcare areas with so many products, they aren't overly reliant on any single one. If one area slows down, the others can help keep things stable overall. It's like not having all your eggs in one basket.
Like diversifying your investments, but for their business lines.
Exactly like that.
Yeah.
Then there's their R&D pipeline, research and development. They spend a lot consistently creating new stuff.
Keeping ahead of the curve.
Yeah, staying ahead, replacing older products as patents run out or technology moves on. Innovation is just crucial in healthcare.
Always needing the next big thing.
And don't forget their cash generation. It's exceptional. They consistently bring in way more money than they spend.
Which gives them flexibility.
Huge flexibility. Lets them reinvest in R&D, pay dividends to shareholders, and, importantly, buy other companies. Strategic acquisitions.
Right. Buying up promising businesses.
Exactly. Which actually leads to another piece of the moat. Their massive sales force. It's powerful.
How does that help?
It makes them a really attractive partner for smaller biotech firms, the ones with cool new drugs but not the muscle to sell them globally.
J&J has the reach.
Precisely. J&J's sales network gives those smaller companies instant market access. They need J&J.
Okay, yeah, I'm starting to see how all these layers build up that strength, that moat. Let's shift to their financial health. How do the numbers look?
Well, the report really emphasizes that strong cash generation again. Their free cash flow. That's the cash left after all the bills and investments are paid.
The money they actually have to play with.
Exactly. It's over 20% of their sales. That's really healthy. A great sign of efficiency.
20% is pretty high.
Yeah.
What else signals they're financially solid?
They have this incredibly long history, over half a century, of increasing their dividend payments to shareholders.
Wow, 50 years plus.
Yeah. That kind of track record usually signals a company that's not just stable, but really committed to returning value to its owners. It shouts reliability.
That's quite a statement of long-term stability, isn't it?
Absolutely. And like we touched on with the moat, all that cash lets them go out and buy companies to fuel growth.
The acquisitions.
Right. The report mentions some big recent ones: Actelion, Momenta Pharmaceuticals, a Biomed, Shockwave. These deals help them get into new areas or strengthen the ones they're already in.
So using their financial muscle to grow strategically. Okay. Now, the big question for many listeners. What about the stock price? Is it like a good value right now, according to this analysis?
That's always the key question, isn't it? Morningstar gives what they call a fair value estimate. It's their assessment of what the stock is really worth.
Okay.
So as of mid-April 2025, J&J's stock was trading around $153, $154. Morningstar's fair value estimate now, this is based on their analysis from back in September 2022, keep that in mind, is $164.
Okay. So the price is currently lower than what Morningstar thinks it's worth. Does that suggest it might be undervalued?
That's exactly what it suggests. They also give a ratio, price to fair value, or PFVE. For J&J, it's 0.94.
And below 1 means?
Generally, yeah, a ratio below 1 can suggest the stock might be trading at a discount to its estimated sort of intrinsic value.
Interesting. So based purely on that snapshot, J&J stock looks like it could potentially be a decent deal?
That's one interpretation, yes. But, and this is really important, a fair value estimate is just that, an estimate.
Right, not a guarantee.
Not at all. It's based on Morningstar's specific research, their assumptions, and those things can change. New information comes out, market conditions shift.
Of course. The market's always moving. Now, the report also had some historical numbers and projections, right? What do those trends tell us?
Looking at the financials, yeah, the report shows pretty consistent revenue growth over the last few years, averaging around 5% a year.
Steady?
Yeah, steady growth. And analysts are projecting something similar, maybe a bit higher going forward. Mostly driven by pharma and new medical devices, it paints a picture of a stable, expanding business.
Okay, so not just a snapshot, but a look at the track record and the potential path forward. Now, even strong companies face hurdles. What are the potential risks, the uncertainties for J&J?
Right. No company is risk-free. Several important ones are flagged. First, there's growing pressure from patent expirations. Big one.
The patents on their key drugs running out.
Exactly. As those patents expire, cheaper generic versions hit the market, and that can really eat into sales. It's just a natural cycle in the pharma world.
The protection ends eventually.
Right. And linked to that, there's just more competition generally, even for drugs still under patent. Other companies are always developing new treatments, trying to grab market share.
Healthcare is super competitive. Always new stuff coming out.
Absolutely. Then you've got the ongoing legal battles. The big one is the talcum powder litigation.
Yeah, that's been in the news for ages.
It has. And the recent setback with that $9 billion settlement attempt, it just adds a lot of uncertainty about how much it might eventually cost them, even though J&J has won some individual cases lately.
So that legal cloud is still hanging over them.
It is. And legal fights are expensive, take time, and, they don't help the company's reputation either.
True. What else?
The report also brings up potential U.S. policy changes around drug pricing.
A perennial issue.
Always. Given that maybe a third of J&J's revenue comes from U.S. prescription drugs, any big changes in how drugs are priced or paid for that could directly hit their sales and their profit margins.
Governments always want cheaper drugs, which can squeeze the companies.
That's the tension. And finally, they just briefly mention potential future costs tied to product governance, ESG risks.
ESG, environmental, social, governance.
Right. So in this context, it's about potential liabilities or reputational hits from issues with the product's safety, effectiveness, things like that.
So managing the risks associated with the actual products they sell makes sense.
Okay, so those are the challenges. But looking ahead, J&J must have plans for growth, right? What are the key drivers they're banking on?
Definitely. The report stresses how critical new drug launches are to offset those patent losses we talked about.
Replacing the old with the new.
Exactly. They specifically call out immunology drugs, like Tremfya. Morningstar thinks it could be a real blockbuster, over $1 billion a year in sales.
Tremfya's had some good results, hasn't it, against competitors?
Yeah, strong data, apparently beating a major rival head-to-head for treating psoriasis. They also point to oncology cancer drugs, things like carvamectin, and a combo treatment, ribavirin clues for lung cancer. Big hopes for those too.
So innovation in key areas like immunology and cancer is crucial.
Absolutely. They also mentioned the acquisition of Intracellular. That brought in a drug called Caplita.
What's that for?
It's aimed at boosting their neuroscience area, treating things like schizophrenia, depression, big areas with unmet needs.
So acquisition's still playing a big role in their growth plans.
Seems like it. And beyond drugs, they see potential in medical devices too. Especially in cutting-edge fields.
Such as?
Surgical robotics is one. And using digital data more in healthcare for better diagnosis, better treatments.
Robotics and data. Yeah, that definitely feels like the future of medicine.
It does. And the report mentions J&J has actually set a long-term target, 5% to 7% annual revenue growth between 2025 and 2030.
That's pretty ambitious for a company that big, isn't it?
It shows confidence, I guess. Confidence in these growth drivers despite the challenges.
Okay, let's zoom out a bit. What about external stuff? The bigger picture, politics, economics. What could affect J&J?
Well, the report flags President Trump's recent executive order on lowering U.S. drug prices. That was mid-April 2025.
Ah, yes. That could be huge for the whole industry.
Potentially, yeah. The analysis suggests it's a bit of a mixed bag, though.
How so?
Well, some parts might actually help innovation, like fixing the pill penalty. That's about different market exclusivity periods for different drug types under Medicare.
Oh.
Making that fairer could encourage more R&D.
Okay, leveling the playing field a bit. Sounds positive.
But other parts, like maybe bringing back the idea of using international prices to set U.S. prices, that could be negative.
Right, because U.S. prices are generally higher. Forcing them down could hurt profits.
Exactly. It could make developing new drugs less profitable, potentially, not just in the U.S., but globally.
A double-edged sword, then. Potential good, potential bad.
Pretty much. And Morningstar emphasizes they haven't changed their J&J valuation yet because, frankly, the order lacks detail.
Need to see the specifics first.
Right. The real impact depends on how it's actually implemented. Could end up being net positive, could be net negative. Too soon to tell.
Makes sense. What about tariffs? That was a worry for a while.
Yeah, the report touches on that. There was concern that broad tariffs could hurt pharma companies because their supply chains are so global.
But
it seems like pharma was mostly exempted from a recent 10% global tariff, which is probably a relief, I bet.
Still, the analysis notes there are ongoing risks to profit margins and maybe higher taxes long-term if companies feel pressured to bring more manufacturing back to the U.S. to avoid future tariff issues.
So global trade, tax policy, still factors to watch?
Always.
Okay, let's switch gears to how J&J actually manages its money, its capital allocation. What does Morningstar think about that?
They give J&J a standard rating for capital allocation.
Standard, meaning okay, but not amazing.
Sort of. It means they think J&J has a healthy balance sheet, a reasonable investment record, and generally gives fair returns to shareholders' dividends, share buybacks. It suggests a, balanced, responsible approach.
Solid, not spectacular.
That's a fair way to put it. They do point out J&J tends to spend more on R&D and pharma than the industry average, which is good for future innovation.
Right.
But they also suggest that maybe innovation in their medical device side has lagged a bit behind competitors, especially in hot areas like robotic surgery.
So strong in some areas, maybe room for improvement in others.
Exactly. And on acquisitions, their view is a bit mixed, too.
Hmm.
Some deals, especially recent device ones like Biomed and Shockwave, look strategically smart, good use of cash. But others, like buying Actelion way back, they felt J&J paid too much.
So not every acquisition hits it out of the park.
No, not always. But overall, they think the dividends and share buybacks are appropriate. Good value for shareholders without stopping the company investing in growth.
And that long dividend history speaks volumes, as you said. What about leadership? There was a change at the top recently, wasn't there?
Yes, Joaquin Duato became CEO in early 2022.
And the thinking on that.
Well, he's an insider, loads of experience within J&J, ran both pharma and consumer divisions successfully. So the expectation is basically continuity, sticking with the strategy focused on innovation.
No big U-turns expected.
No. The report highlights his deep knowledge of the business and the strong team around him, suggests a smooth transition, consistent direction.
Okay. Now, something investors care more and more about, ESG, environmental, social, governance. How does J&J stack up there?
Sustainalytics, which is owned by Morningstar, gives J&J a low ESG risk rating.
Low risk. That sounds good.
Yeah, it indicates that compared to others, J&J's value is seen as having relatively low risk from these ESG factors.
Are there any specific ESG areas that are more relevant for J&J?
Yes, the report points to two main ones. First is access to basic services, which really means drug pricing and affordability, a huge social issue.
Makes sense.
And the second is product governance. That's about product safety, making sure drugs work, responsible marketing, all that stuff.
So making drugs affordable and making sure they're safe and marketed properly. Key responsibilities.
Absolutely. Crucial for their ESG profile. Okay, finally, the report gives a quick comparison to some competitors. What does that show us?
Right. It looks at Eli Lilly, LLY, Merck, MRK, and Procter & Gamble, PG. Though PG is more consumer-focused. Interesting comparison.
Okay. And valuation-wise?
Well, as we said, J&J's price-fair value ratio was 0.94 as of mid-April 25, suggesting it might be a bit undervalued. Eli Lilly and P&G were both over 1, suggesting potentially overvalued based on Morningstar's numbers.
And Merck?
Merck was also below 1 like J&J, suggesting it too might be undervalued. So it gives you a relative sense.
Interesting. And what about their moats?
All four, J&J, Lilly, Merck, and P&G, are rated as having wide economic moats.
Wow. So all considered very strong, durable businesses.
Yeah, underscores how powerful these established players are. Even with wide moats, though, the market values them differently at any given time.
And the overall Morningstar ratings, quick recap.
Sure. As of that date, J&J and Merck both had 4 stars, meaning Morningstar saw them as undervalued. Lilly had 3 stars, fairly valued, and P&G had 2 stars, potentially overvalued.
So a mixed picture even among these giants. Okay. Well, that was definitely a deep dive into J&J. Let's try and pull the main threads together.
Okay, summary time. In essence, Johnson & Johnson is this huge, very diverse healthcare company. It has really strong, lasting competitive advantages, that wide moat.
Right. And financially, they look solid. Great cash flow, that amazing dividend history. Plus, they're actively working on future growth, new drugs, acquisitions.
And there's always a but. There
Yeah.
are real challenges, too.
Definitely. Those patent expirations are a constant pressure. The legal issues, especially the talc stuff, are a significant uncertainty. And then there's the whole drug pricing regulation question mark hanging over things.
Critical factors to weigh up.
Absolutely. So it's a complex picture, like it always is with big companies. But hopefully this analysis gives you, our listener, a good framework for how the pros look at a major player like this.
Yeah, whether you're thinking about investing yourself or just want to understand the healthcare world better, getting a grip on these things, the business model, the moat, the finances, risks, growth plans, it's pretty crucial.
It helps you make sense of it all, understand the forces shaping things.
So for you listening, what stood out? Was it the power of those patents, the complexity of drug pricing debates, or maybe the sheer pace of medical innovation? Whatever sparked your interest, maybe dig a little deeper there.
And maybe a final thought to leave you with. How do we as a society actually find that balance? The balance between encouraging companies like J&J to innovate, to find those next breakthrough treatments.
And making sure those medicines are actually affordable and accessible for everyone who needs them.
Exactly. It's a tough question, and the answers will definitely shape the future for these companies and, well, for all of us.